What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today we're going to talk about offsetting your passive activity losses when you sell a rental. So, as you probably remember, your rentals are by default considered a passive activity. So all activities are either passive or non-passive, and those passive activities come with special rules that limit your ability to deduct losses. So any business in which you do not materially participate is considered a passive activity. And rentals by default, whether you materially participate or not, are considered a passive activity. Now, there are three ways to escape the passive activity loss rules when it comes to rentals, and that's qualifying as a real estate professional, 2, active participation with income less than $100,000, or 3, complete disposition of the rental activity. So today, obviously, our focus is on number 3. Now, when you sell your rental with suspended losses, those losses are released and will offset your ordinary income. So as you own the rental and incur losses year after year, if you're not able to deduct them in those years, those losses are suspended and carried forward as passive activity losses until some future time when you have passive income. If you sell the property while there's losses that have been suspended and carried forward, they're released at the time of sale. This is why it's important to track all of your expense and deductions while you own the property, even if you can't deduct the passive losses in the year you incur the expense. So you want to make sure you capture everything that you're entitled to. Obviously, we're only referring to legitimate deductions because they do accumulate and carry forward. At some point, you will receive the benefit of all those expenses that you incur. And when you sell the property, those losses are going to offset your ordinary income, your W-2 income, active income from other businesses. Now, many people, including some CPAs, believe the suspended losses will only be used to offset any capital gains from the sale of the property, which is inaccurate. If you sell for a gain, you're going to have some depreciation recapture. You might even have a capital gain to deal with if you sold for more than what you purchased the property. But the suspended losses come out, they reduce your ordinary income. So they're reported on a separate area than the depreciation recapture and the capital gains on your tax return. Capital gains and depreciation recapture are also taxed at a lower rate than your ordinary income in most cases. So the maximum capital gain rate is 20%. The depreciation recapture on real estate is capped at 25%. The ordinary income tax rates go up to 37%. So the capital gains and recapture capital gains will always be lower than your ordinary income rate. The depreciation recapture on the real estate will be equal to or capped at 25%. So if it's capped at 25%, you get a break if you're in a higher tax bracket than that. If you're in a lower tax bracket than 25%, the depreciation recapture will be taxed at your ordinary income tax rate. So those suspended losses that are being released, being treated as non-passive income, is much better than they would be if they were treated as, say, a capital loss. Now, it's true the capital gain from the sale is used. It allows suspended losses to be freed up, but they have a different character in the eyes of the IRS. There's capital, and then there's the non-passive ordinary losses. Now, if your accountant or someone else tells you differently, you can actually point them to IRS Chief Counsel Advice 2013 013-11-055-1226, which addresses this specific issue. So we're going to read a little bit right from that IRS CCA that explains the IRS's view on this. So it says, it is true the gain from the disposition of property used in a passive activity is treated as passive income for purposes of applying the passive loss rules. Passive activity loss is defined in section 469D1 as the amount, if any, by which A, the aggregated losses from all passive activities for the taxable year exceed B, the aggregate income from all passive activities for the year. Basically, that's saying your passive losses exceed your passive income for the year. And it goes on to say, accordingly, for the limited purpose of calculating the disallowed passive activity loss of a taxpayer for the taxable year under this section 469D1, the gain on the disposition of property used in a passive activity will be allowed to offset passive losses from the same or other passive activities of the taxpayer. The character of such gain or loss as capital or ordinary has no relevance for applying the rules of section 469, because the passive loss rules are only concerned with whether the relevant income and loss are from a passive activity. Instead, once it is determined that the passive losses of the taxpayer are no longer subject to disallowance under section 469 for the taxable year, because the losses are either offset with a corresponding amount of passive income or are recharacterized as not from a passive activity, the tax rules that would otherwise apply to such gain or loss outside of section 469 will control the extent to which those gains or losses must offset each other for the tax reporting purposes and for calculating the amount of tax due. So in other words, it's saying while there's a gain here from a passive activity that allows suspended losses from passive activities to be released, but they retain their nature. So if it's a capital gain, that's handled one way outside of section 469. If it's an ordinary loss, that's going to be treated as ordinary because it's outside of section 469. So it then goes on further to say section 469 is merely a loss disallowance provision, and as such, it does not change the character of any gain or loss once the loss is no longer subject to limitation under that provision. In this case, the rules under section 1211.1211, that's the code section which limits capital losses to $3,000, will determine whether the capital gain from the property must offset the ordinary losses produced by such property, and section 469 will play no role in this determination. Moreover, there's no provision in section 469 or the regulations thereunder requiring the offset of capital gain with ordinary losses. So basically, that was the end. This is confirming the released passive activity losses will offset ordinary income because they were ordinary losses. They were simply suspended as passive, and they're not treated as a capital loss. So this Chief Counsel advice out there, it's Chief Counsel Advice 2013-01-311-055-1226. That's where you can use, that's where you can find the IRS's position on this. Now, so that really covers our conversation on how you treat the suspended passive losses when you sell a property. So let's touch on a quick Q&A. We had a question from a listener. So this person asked if losses from a short-term rental with 50% personal use would be allowed or would they be suspended? So a rental, whether it's a short-term rental or otherwise, if it has personal use and the personal use is greater of 14 days or 10% of the fair rental days during the year, then it's considered a personal residence and deductions are only allowed to the extent there is income. So these aren't passive losses per se, but they're personal losses. So there is no personal loss. The deductions are limited to income. So then there's no loss. Now, things like depreciation and interest and the taxes, there is a carryover provision that could offset future income from the property, but they're not technically passive. And again, they're not deducted in that year. And if you sell the property, they are gone. There's no freeing up of losses in this case because it's a personal asset. So personal assets are governed by a separate section. They're not part of the passive activity loss rules under section 469. So that about does it for today's episode of the CPA Zone. I hope you enjoyed it. If you found value in this episode, please leave us a 5-star review, hit that like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact. relied.com/contact.